Welcome to Creating Value Wins. I'm Steve Denning. I'm here with my fellow co-hosts, Hunter Hastings, Doug Kirkpatrick, and Hugo Lorenzo. And we are here today to discuss the meaning of our mantra, Creating Value Wins. We believe that by creating value for others, we actually end up creating more value for ourselves. And we believe that this is a maxim both for individual lives and for businesses in particular, and for politics as well. This is a way of approaching life. We are not the first people to adopt this mantra. It's very similar to what Christian religion talked about, loving your neighbor as yourself. Creating value for your neighbor creates value for yourself. And this, if we look over the realm of history, this is something that is a fairly accurate picture of what has happened in the human race. But for the last 50 years, a very different idea has taken a hold, particularly in the US in business, and that is the idea that making money for yourself will actually create lots of value for society. You don't need to worry about creating value for anything else. You just look about creating value for yourself, and in the process, society will be better off. This began in 1970, an article in the New York Times, and then spread throughout the whole of business. It was took over the U.S. business. 1997, the Business Roundtable in the U.S. endorsed this as the official way that business should proceed. They should be selfish and look after themselves, and society and everyone would be better off if they did this. And businesses acted in this way. And over the next 20 years, in fact, there was a huge public outcry that this was actually very bad for society, that having selfish businesses created a lot of harm for society. And in fact, in 2019, the Business Roundtable got together with several hundred leading businessmen and said, that was wrong, we made a mistake, and we shouldn't do that. But in fact, nothing really changed. In fact, the studies show that businesses continued to act in this way. And so we are now going to be looking at situation has remained quietly and in the dark of night. Businesses are still looking after themselves, being selfish for themselves, but talking about creating value for others, but not actually doing it. But now we have some breaking news. The breaking news is that the leading management journal in the world, Harvard Business Review, has published two articles, one by Bain Consulting Group and the other by BCG, another leading business group, arguing that maximizing shareholder value, the idea that selfishness should once again prevail throughout business, that should be the way we should do it. The Bain article does it explicitly. The BCG makes the argument implicitly that if you, in fact, focus on creating value for yourself, you will create value for customers and everyone else. This is really a startling development that such a thing should be happening. It maybe shouldn't be a surprise if we look at the daily newspaper and see what's happening in politics, because this idea is spreading strongly in part of politics. But we'll be talking today about business. We'll be looking at to what extent this is true. We look over the whole of particularly the last 250 years, what has actually been creating value for others? Has that been productive? And it also being focused on creating value for yourself, has that been productive? So let's start with Hunter and take the first couple of hundred years from the mid-18th century. What's been going on? Are there organizations which have been focused on creating value for others, and how did they do? Hunter?
Well, thanks, Steve. Let's go back to the beginning, and I would put that at the late 1700s. It's the beginning of economics with Adam Smith. It's the beginning of state politics with the Declaration of Independence. And in the UK, it was the beginning of customer capitalism. And we can highlight a typical entrepreneurial firm. It's Wedgwood, ceramics like cups and saucers and jugs that were quite revolutionary and innovative at that time. So Josiah Wedgwood, with one private investor, Thomas Bentley, identified a new set of tastes and habits that were emerging from customers in the marketplace. They were starting to have some leisure time. They were starting to have dinners and tea parties where they could entertain guests. And they were using new, different beverages, hot beverages like tea and coffee and hot chocolate. All of these were new. And Josiah Wedgwood invented the plates and saucers and the ceramic glaze, which was a big innovation at the time, to make that possible. He made them pretty in creamware with interesting colors. He revolutionized the production line with new kinds of ovens and new kinds of production techniques, revolutionized marketing. He developed some of these dinner sets, a famous 292-piece dinner set for the Empress of Russia, Catherine the Great. He exhibited that in London as a marketing event before he shipped it off free to Catherine. So that was kind of influencer marketing. He had queenswear now. He had purveyor to the royalty. And so there was constant evolution, and he was improving the lives of his customers. There was a new emerging middle class coming about because of the Industrial Revolution and capitalism. And these folks wanted new things, better things, more interesting things. They wanted to feel sophisticated. They wanted to feel social. They wanted to be noticed, all the things we think about consumerism today. And so Josiah Wedgwood and his private investor, Thomas Bentley, represent that wonderful start to customer capitalism. He was focused on creating value for his customers, and that's where it began.
So, Doug, would you like to tell us what happened next?
Well, I think the next turn in the evolution is the idea of robber barons in the United States. And that pejorative term actually presents a much more complex picture than the short-term self-interest that's implied by the term. So where did the term come from? Well, it came out of a 1859 New York Times editorial by Henry Raymond, and he compared Cornelius Vanderbilt, the American industrialist, to those old German barons who from their eyries along the Rhine swooped down upon the commerce of the noble river and wrung tribute from every passenger that floated by. So by the 1870s, the term robber barons was in wide circulation, applied to Gilded Age tycoons like Rockefeller and Carnegie, Vanderbilt, and others, and then further popularized in a 1934 book by Matthew Josephson called The Robber Barons. So in short, the phrase began as a description of medieval Rhine lords who exploited river traffic through illegal tolls, and then was applied to certain 19th century American industrialists. But the picture is very complex because figures such as Andrew Carnegie and Rockefeller pursued aggressive and sometimes ruthless consolidation and cost-cutting that concentrated economic power, sometimes crushing competitors, and with tactics that were described as predatory. However, their efforts produced sharp declines in the prices of steel, kerosene, oil, and transportation. So their efficiencies actually made lighting and gasoline affordable for millions of people. And Carnegie drove down the cost of steel that built modern American infrastructure. So many of these industrialists then went on to direct gigantic fortunes toward libraries, universities, and public institutions. Their self-interest, yes, was real, yet it expanded supply and it lowered prices and it created massive value for customers. It was not purely rent extraction. So if you look at Henry Ford, for example, his explicit goal is not to maximize margins on every car, but to build a motor car for the great multitude. So he systematically lowered prices, raised wages, created the $5 a day, which is impressive at the time, and redesigned production so that ordinary workers could eventually buy the product they made. He created a vast new class of customers, helped make Ford one of the most valuable enterprises of its time. And later, organizational rigidity hurt the company when customer taste shifted, but the founding insight remained: customer creation at massive, unprecedented scale. If you look around at the modern era, some 30 company founders, Jeff Bezos, Elon Musk, and others, were recently analyzed and found to have created some $32 trillion in wealth for other people. That's almost 25% of global gross domestic product. Some might look at that statistic and say, well, if that's what robber baroning looks like, let's have more of it.
But it's important to keep in mind that this $32 trillion that was created also put a lot of businesses out of business, in the same way that the robber barons put out of business firms that were making very expensive kerosene, for instance. They were able to produce kerosene at 3 cents instead of $1. The gains for society were enormous, but the people who were selling kerosene for $1 a gallon instead of 3 cents were no longer in business. And so those robber barons got attached to the label robber barons because they were seen as destructive, but it hid, as you say, the value they were creating. If you take Henry Ford, for instance, he also put a lot of businesses out of business. Firms that were making horse and buggy carts, they were put out of business. Firms that were making very expensive motor cars, they were put out of business. He destroyed, if you like, a lot of business, and he could have been seen as a robber baron because he caused all that destruction. But instead, in his case, he is largely credited with creating the value. So business is a creative and destructive thing. In order to create new value, unproductive businesses are put out of business, and need to keep in mind those aspects of things. If we turn to the people who are writing about business, we see that in the 20th century, although there was a lot of emphasis with the whole idea of scientific management and Taylor, with the theory that you did business through processes, and you had processes that were most effective and with hierarchy. There were writers who at the same time were saying, look, that's a very narrow view of what's going on. People like Mary Parker Fuller in the 1920s was pointing out that, in fact, you needed to look at who was actually benefiting from these processes, who was actually getting the money, and that we needed to look at the overall impact of what was happening. She was a woman, and she was treated as the way many women were when they were saying things which are ultimately true and correct, and was ignored. What was more startling was the fact that Peter Drucker, who in some ways would be regarded as the most eminent management thinker of the 20th century, he articulated the idea that the only valid purpose of a business is to create a customer. So in one sentence, he summarized what we're talking about here, that this is the purpose of a business, and the only valid purpose. Any other business is invalid. However, in 1970, as I say, that idea was cast aside, and the whole set of businessmen took the opposite point of view, that making money for yourself was the purpose of life and the purpose of business. And Peter Drucker's statement was just totally ignored. And maybe, Hunter, you could tell us a little bit more about why that happened. Why did business set aside all of the things that you pointed out, the wisdom of Mary Parker Follett, the wisdom of Peter Drucker? Why did they set that aside and say, let's just focus on making money for ourselves and everything will be much, much better off?
Well, let me build on something that you said in your discussion there, Steve, about creative destruction, that businesses are destroyed. That's the kind of negative terminology that starts to get capitalism a bad name. As you, I think, intended to say, nothing's destroyed. The preference for 3-cent kerosene over $1 kerosene is the customer's verdict. And the customer's verdict determines which companies succeed and which don't, and it keeps the market refreshed and it keeps everything on the leading edge. So in 1970, Milton Friedman tried to summarize that idea, and he said in his 1970 essay, the title was specifically, "The Social Responsibility of Business is to Increase Its Profits." So the social responsibility he was talking about is to accept the verdict of the customer. Profit is the ultimate signal from the customer that a firm is using society's resources in the right way. So the best way to figure that out is, do you make a profit or not? Is the customer willing to pay above the costs of production for the value that's being created? So I think Friedman was well-intentioned. But then came along other academics trying to pile on Milton's back, like the paper you mentioned from Jensen and Meckling about agency theory, which was those people in capitalist companies are really bad people, and we have to keep them under control. So the investors have to do that. They have to make sure that the company responds to its investors rather than respond to the verdict of its customers. And so that is another pivotal piece of academic bad thinking that got itself into the mainstream. And so now managers and entrepreneurs and capitalists start to think, well, I've got to serve my shareholders. I'm just an agent of their interests. And so that leads along the path to share buybacks, to dividends before innovation, to cost control, rather investing in new assets that create future value. And it led to that behavior that focused business on a narrow purpose, which was shareholder value, instead of the long-term purpose of creating new value for customers. And that just accelerated and accelerated to the point where you said that maximizing shareholder value became the mantra for business. And the consequences of that are short-termism, because the market started to look at quarterly earnings and it started to look at the daily stock ticker. The perspective became shorter and shorter. And short-termism is the antithesis of the long-term purpose of capitalism, creating value for customers. So that was a thread over, as you described, 20 or 30 years that really was parasitic to the idea of creating customer value.
Well, let me just add one thing, Hunter, because I don't think profit is the enemy. Profit feeds the company. It pays for talent, experimentation, resilience, and the future. What does it mean? But the danger is confusing today's results with the long-term health of the business. A company can report an excellent profits because it's harvesting a position built in the past, while quietly is consuming the capabilities to produce something tomorrow, results. So the profit tells us about what the company harvested this year, but what does it tell us about he's replanted enough for the future? So I believe most companies are perhaps doing some savings, but I think the trade-off is those savings are not being invested in a way they can replant for the future. I think it took some time for agriculture and fishermen to understand that. In agriculture, they know that if they don't clean the field, they cannot do the next harvest. And fishermen took them a long, long time to understand there was no fish in the ocean. They need to find other oceans, but they take it until they take it all. So they don't understand this concept very well of seeding again, replant again, so they can have a better future. So I think at a certain level, companies in many ways also put themselves in a position to be a little bit like that. But Doug, what do you think about all this and the ecosystem's digital power and the rediscovery of the customer?
Well, there's always an evolution. And so the other evolution that's coming along now is we're understanding that customers actually matter. In 1990, James Moore argued that businesses operate in ecosystems of suppliers, customers, complementary institutions, and even competitors. Success depends more on shaping those collaborative systems that create value for end users instead of having a win-lose, zero-sum rivalry. So firms that try to capture everything in the process may destroy the ecosystem that sustains them in the first place. And what we found was that digital technology shifted power toward customers, gave them more information, more choice, much more of a voice in creating the products that they desired while lowering switching costs. We had online reviews, much social media commentary about products, comparison tools, mobile commerce. All these technologies enhanced and turbocharged the shift of power toward customers. So companies that treated customers as passive targets of advertising and ultimate extraction became very vulnerable. And those that treated customer experience as the primary asset gained strategic competitive advantage. An example would be Amazon under Bezos. He embodied the approach through relentless customer obsession rather than even thinking about competitors or short-term profits, accepting lower-term, near-term margins, while expanding selection and speed and convenience for those customers. So the strategy of creating and retaining customers at massive scale produced durable economic returns, and it reaffirmed the original insights of people like Drucker and Wedgwood and Ford for a new era of technology.
I think the shift in context, I think, was absolutely fundamental. If you look at the period 1970 to 2000, in fact, what Milton Friedman was saying was not such a bad fit for that world, because in that world, things were relatively stable. Sectors were stable. There were three firms basically at the head of each sector, and they were fighting each other. And the question was who had a slight edge on the other among the three firms. And there wasn't much change. And to some extent, what he was saying was a fairly good fit with that. Then, of course, as you say, when the customer had access and digital information about what was available and could find out what there were alternatives, that there were new products that were not those three manufacturers, then they started to have choices. And then firms like Amazon, well, we can take advantage of that. We can actually make these much better products available for these customers, and they can learn about them and so shift. So what you see now is that instead of the three manufacturers of, say, packaged goods, Procter & Gamble, Unilever, and Colgate, which dominated the market in the late 20th century, suddenly they are being undermined drastically by the brands, the private brands of firms like Amazon and Walmart and others that can make products which are much cheaper than anything that those three manufacturers can do. Or you get firms like ELF Beauty, which are able to operate at a fraction of the cost of those traditional firms, which are built on bureaucracies and old-fashioned ways of doing things. And so the whole commercial world has been turned upside down. And so that what you did yesterday might be totally unsuitable and inadequate for dealing with tomorrow. And so the stock market has learned from that. And so instead of simply projecting the future from what happened in the past, they start to look at what are you going to do for us tomorrow? What new things do you have going? Is your business likely to continue? And if you're simply doing the same old thing, then we are going to expect that you will be put out of business fairly shortly, and you will need to have a new CEO who will be imposed on you, and all sorts of other things will happen to you unless and until you start to have a more aggressive way of creating value for others, creating value for your customers, instead of focus on simply making money for your business. So it's a change in the context has totally undermined and revolutionized the whole way of thinking about how organizations function and why creating value wins. And we actually have a segment on our podcast where we shift to saying we've been talking about dumb ideas. These are not the only ones we've talked about. And so let us introduce our segment, the world's dumbest idea, world's dumbest management idea. So we ask each of our participants in the show to say, what is your assessment of this week of what is the world's dumbest idea? And so maybe you start with Hunter. What is your world's dumbest idea this week?
So based on the context of what we've been discussing here, I am going to nominate the IPO, the initial public offering. Now, it's not an unalloyed bad idea, but it has led to a lot of the short-termism and gambling, casino behavior that we see in the stock market today. The first IPO was, to go back to my history, 1783 for the first US bank. And it immediately generated reckless behavior. People piled money into their carriages and ran the gauntlet of British soldiers to get to Wall Street to pile money into the US bank IPO. And as the IPO has matured since then, obviously it's a good thing for entrepreneurial companies to get capital, but all of the spin-off institutions like the daily stock ticker and the demand for quarterly earnings statements result in this reckless behavior by people who are not long-term investors, but are gamblers. The hedge funds that are flipping stocks every day, they're long, they're short, they don't care. They're not thinking about customers and capitalism. And all of the share buybacks, instead of investing in capacity, all of the dividends that have gone to investors as opposed to value for customers. So the IPO is part of the problem.
Hugo, what's your world's dumbest management idea this week?
I think I might slightly disagree with the premises that I don't think profit or shareholder value is the word dumbest idea. And perhaps that's the dumbest idea. Because a company without results eventually loses its ability to create value for anyone. I think the mistake that we keep repeating is treating the results as the purpose. And we already covered that today with some examples. And then assuming that the good result proves that the underlying company is healthy. It may not. Results tell us the company has harvest. They don't necessarily tell us whether it's replanting or not. A company may be profitable while its customers become less enthusiastic, its employees less excited, they learn less, the suppliers grow weaker, and the innovation reduced to adding another blade to the same razor. Because that brought me to the idea of the Dollar Shave Club. I think it's a useful example. For years, innovation in shaving, which I don't use as much as you gentlemen, but I think largely meant adding another blade, another strip, or another technical feature to the cartridge. And this small company Dollar Shave Club didn't begin by trying to manufacture a technically superior razor, but they want results as well. They were also wanted the profit. They also want to invest and to grow. But rather than putting another blade, they redesigned everything around the razor. It was a subscription. It was a direct delivery. It was simple pricing. It was the convenience, irreverent communication, and eventually even a broader refinement relationship with the customers. For Gillette, it was also basically about optimizing the product. It was so easy, so comfortable. Just sell it there, wait for people to take it. And so they kind of, for them to think, having becoming bold and increase the boundaries of reimagining what the system around the customer would be, it was not part of their culture. So how do we know when we are generally innovating and when we are merely adding another blade to the same old razor? I think the practical question is therefore not whether we should choose profit or purpose, is whether today profit is feeding to more value creation, or perhaps quietly silencing, preventing it, and killing us. So perhaps the clearest test of a healthy company is this: are we willing to reinvent our own profitable model before someone else does it for us?
Exactly. Doug, what is your suggestion for this week's dumbest idea from your perspective?
Well, so many to choose from. Sometimes it's difficult, but I'm going to look at what we talked about today. We described a number of different business leaders in different eras of business around the world. And my dumbest management idea is the idea that businesses can spend inordinate amounts of money and resources on leadership training without having any idea what they're getting for their money. You can tell a lot about a business by what it invests in, and businesses spend about $400 billion a year on leadership training and don't really know what the return on investment is. We talk about sending people to classes and online courses and reading books and spending inordinate amounts of time workshopping and seminaring and trying to develop leaders. If businesses looked around, they would realize that every single person in their ecosystem is a potential leader, and make those opportunities possible for everyone so that they can develop these rich and vibrant, exciting ecosystems full of leaders that can innovate and create value for customers and figure out how to transcend this whole idea of short-term focus on profits at the expense of clients and customers.
Those three ideas, we will be exploring them in the subsequent episodes. From my perspective, it's difficult to beat maximizing shareholder value, which has been declared as the world's dumbest idea publicly by eminent business leaders. But one further dumb idea that we'll be exploring in our next episode is the idea that every organization, no matter what they are, should be run as a hierarchy. Someone should be in charge of the firm and should be giving instructions to everyone else in the organization as to what to do. And we will be suggesting that that idea is one of the dumbest ideas in the world, and that there is many organizations today are much more effective when they are seen as networks and ecosystems which are interacting with a whole array of partners, in which there is a hierarchy as part of the system, but it's not entirely a hierarchy. It's not being run totally as someone at the top giving instructions to the rest of the firm. So we'll be exploring that in our next episode. And if you want to explore more of what we've been talking about in the prior 12 episodes, you can go to the site on YouTube where we have a repository of the 12 previous episodes. And so if you go to youtube.com and go to at Creating Value Wins, our mantra, YouTube at Creating Value Wins, you can watch all of the 12 episodes in their entirety, and you'll be able to see some 40 short 20-second, 30-second, 2-minute episodes, which give you some insights on particular snippets and particular aspects, which are done. If you don't have 40 minutes, 30 minutes to listen to the whole thing, you can get 30-second, 60-second episodes. And some of those are fun, some of those are profound, but they're all interesting. And so we look forward to being with you next week for continuing the podcast, Creating Value Wins. Thank you very much for being here.
And remember, profit is like an applause. It's an essential feedback, but a very strange reason to go on stage. See you next week.